Hello. In this video, we'll be going over IRS Form 1099-S, Proceeds from Real Estate Transactions. Before we begin walking through this form, a lot of taxpayers may not be familiar with it, mainly because they've never seen one before, and I'll explain to you why. This tax form is required for reporting all real estate transactions, such as improved or unimproved land, permanent structures to include residential, commercial, or industrial buildings, condo units, stock in a cooperative housing corporation, or any non-contingent interest in standing timber. So that's the literal category of all transactions that are reportable on this tax form. However, there's a big exception for taxpayers who are able to exclude income from capital gains because they're selling their primary residence. So this is part of the tax code under section 121, and it's the exclusion of proceeds for the sale of your primary residence. This is how that works. Each taxpayer, when selling their primary residence, if they qualify, can exclude up to $250,000 of capital gain from their taxable income. And if it's a married couple and each person qualifies on their own merit, then that couple can exclude up to $500,000. For example, in this case, if John Doe had lived in his house and owned his house for 2 out of the previous 5 years, if he had bought that house, let's say he bought it 5 years ago for $200,000, and he's now selling it as listed here for $400,000, that's a $200,000 capital gain, and then he would be able to exclude that if he met that criteria. If on the other hand, he doesn't meet the criteria, let's say that he bought it and then a year and a half later, he decides to sell it, or it was a rental property and he sold it, then he would receive this tax form. So there are 2 criteria to exclude the capital gain from the sale of your primary residence. So first is the use criteria. You must have used this residence as your primary home for 2 out of the previous 5 years. And in for definition, to be specific, each year constitutes 365 days. So any combination of 730 days out of the previous 5 years, if you've used this home as your primary residence, then you can exclude that from taxable income. The second part of that is the ownership rule, where you have to have owned the home and had your name on the title for at least 2 out of the past 5 years. So that's the basic gist of it. There are some nuances to the Section 121 tax exclusion. The IRS has written an entire publication discussing all of those different hypothetical situations, but in the grand scheme of things, that's the general gist. And most taxpayers do usually fall under that category, which is why they would not expect to see 1099-S. But if you own rental property, if you own investment property, or if you are a real estate investor, you're probably a little bit more familiar with this form, as you would receive this each year that you conduct real estate transactions. So we'll take a look at the left-hand side of the form, and then we'll go to the right-hand side of the form where all the tax information is reported. So it is important to note that there are 3 copies to this form. As with all 1099s, copy A goes to the Internal Revenue Service. Copy B should go to you as the transferor or the homeowner. And then copy C is retained for tax purposes by the filer. So usually the filer would be the title company or whoever is mandated to record this transaction. So on the left-hand side of the form, you'll see the filer's name and information. In this case, Acme Title Company did the closing. You'll see their taxpayer ID number, and then you'll see on the right-hand side of that, the transferor's tax ID number. So if you sold the home, you're the transferor. You'll notice that it's truncated. It's truncated on all copies except for the one that goes to the IRS. And as part of the real estate transaction, it is the title company's responsibility to obtain your taxpayer ID number, whether it's a social security number or your individual taxpayer ID number. And on top of that, they're required to ask you to certify under penalty of perjury that you are giving them accurate information and that you are a U.S. citizen or a resident alien, whatever your tax status is. Below the tax ID numbers, in this case, it's our hero, John Q. Doe, and his street address. This account number probably will be blank. It probably will, if there's anything in here, it might be some sort of in-house account number used by the title company, but they're not required to enter this unless they've completed 2 or more transactions in the same tax year for the same taxpayer. So on the right-hand side of the form, there are 6 different information fields. So on date 1, that's the date of closing. The IRS defines the closing date as either the date that is on the closing document. The closing document is the new version of what used to be known as the HUD-1, the closing disclosure. So the closing disclosure replaces the HUD-1 that used to be presented to home buyers and sellers, and it also replaces the truth in lending statement. So they've combined those into one document called the closing disclosure. If there is no closing disclosure, then usually the closing date will be the date of either the title transfer or when the buyer or recipient receives the economic benefits and burdens of owning the property. In box 2, you'll see the gross proceeds reported. Gross proceeds defined by the IRS includes any cash that was received for the real property, and it also includes any notes that may have been forgiven. So, in this, if John had a $300,000 mortgage and received $100,000 of cash, then those two combined would equal $400,000. It does not necessarily reflect any property or services that you may have received as part of that transaction. So in box 3, we'll see the address of the property that was transferred. If the address is not sufficient by itself, you may also see a legal description. So a legal description, you may also see additional narrative, especially for timber properties. So for timber royalties, you may see something like timber royalties. For lump sum timber payments, you may see lump sum timber payment. In box 4, this will be checked if there were goods and services or property or services that were exchanged as part of the consideration. This might be known as a like-kind exchange, and there may be additional tax reporting requirements. In box 5, if that's checked, then that means the transferor or the seller is a foreign person. This could be a non-resident alien, a foreign partnership, a foreign estate, or a foreign trust. There may be additional tax withholding or reporting requirements. More information, you can find that on IRS Form 8288. And then in box 6, this indicates the buyer's part of any real estate tax that may have been prepaid. So as part of the closing transaction, usually the buyer, part of the escrow agreement includes the buyer reimbursing the seller for any prepaid real estate tax as of the date of the sale. For example, let's just say that we'll say this was 7/1/2023, make this easier. And let's just say that John Doe paid $2,000 of real estate tax for the entire tax year. So in this case, the closing document should reflect that on 7/1/2023, the buyer paid back $1,000 of that real estate tax to John Doe. So that $1,000 needs to be accounted for if John Doe itemizes deductions, real estate tax as part of his itemized deductions on Schedule A on his tax return. And if he's already taken a tax deduction, then he would need to declare this on Schedule 1 of his tax return for the previous year. So that's the reason why this is reported here. So that's all we have for this tax form. We do cover down a little bit more on some of these situations, and additionally, we provide more insight on how you may need to report certain transactions on your tax return. You can find all of that in the article that we've written. Simply go to the link that's in the show notes, or you can go to our homepage, go to teachmepersonalfinance.com, type in IRS Form 1099-S, and you'll see the article appear. We'll also put links in the show notes to any forms and schedules that were either mentioned in this article or are pertinent to this article and included in our if we mentioned a form in the video, or if any forms that we cover in our article. We'll put links to the show notes to all of the videos and the articles that we've produced with those relevant tax forms. So that's all we have. If you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And if there's anything that you would like to cover in a future video, please hit me up on the show notes. Thank you very much and have a great day.